Hello and welcome to lecture number 12, where we're going to be discussing multinationals, those are companies, and migration. And this is international factor movements, what we're going to be discussing. This comes from chapter 15 in your book. So let's begin. We'll first start by defining FDI, foreign direct investment. So this is funding provided by investors, and these investors are usually firms, to establish or acquire foreign companies or to expand or finance existing foreign companies that the investors already own. Okay, so if we're sitting in the United States, we're looking at investing outside of the United States. So this is foreign direct investment. The key is sufficient ownership to control or influence the management of the foreign company. So that usually represents a large percentage. The agreed international standard is at least 10% ownership, but a lot of people might consider a little bit higher. So let's say you're looking to invest in a company or start up an affiliate in a foreign country. If you own less than 10%, then it's not considered foreign direct investment. If it's more than 10%, which helps control or influence the management of that foreign company, then we would consider it foreign direct investment. Okay, so here we've got a comparison between foreign direct investment and portfolio investments. So firms will still invest at less than 10%. Foreign direct investment, however, is more than 10%. So here are some examples of US foreign direct investments. Alcoa, which is a big company, purchases of 50% of the stock in a new Jamaican bauxite firm. So they own 50%. That would be considered a foreign direct investment. A loan from Ford USA, so the car manufacturer in the US, to a Canadian parts making subsidiary in which Ford holds 55% of the equity. So again, this is now in Canada. Ford USA owns 55% of this Canadian subsidiary. On the other hand, we've got US portfolio investments abroad. So these are still investments by these companies, but they're less than 10%. So we don't call them foreign direct investment because they don't have as much say or control of what happens with the foreign entity. So Alcoa's purchase of 5% of the stock in a new Jamaican bauxite firm. This 5% is the full amount of ownership that Alcoa then has. So in this case, Alcoa owns 5%. They've helped to fund the company with their investment, but they don't have a lot of control in that company. Only 5% ownership. Here, a loan from Ford USA to a Canadian parts making firm in which Ford USA holds 8% of the equity. Okay, so in this case, again, is less than 10%. So when we hear the different terms, foreign direct investment, we think large investments or a large percentage of ownership. Portfolio investments are just other investments that are made to aid in the expansion of the company. Okay, so these companies that work internationally, we call them multinational enterprises, MNEs. So MNEs, you'll see that term throughout your book and often in business articles and other things. So an MNE is a firm that owns and controls operations in more than one country. So as soon as we step outside the US's borders and own or control operations outside of our own home country, then we are an MNE. So the parent firm of the MNE is located in the home country. The home country is the source country for outward FDI. So if we're looking at it from a US perspective, the parent firm is in the US, and this is where most of the funds are coming from to go outside for foreign direct investment. The MNE has one or more affiliates located in one or more host countries. The host country is the destination country for inward FDI. So the host country is not the home country. It is the foreign country that the multinational enterprise invests funds in foreign direct investment. Okay, so two other terms to be aware of: FDI flows and FDI stocks. So FDI flows, or the flows of FDI, measure new equity investments and loans within M&Es during a period of time. So here we're looking at how much money has flown into new equity investments outside of the home country during a period of time. So this might be over the last year. What are the FDI flows? The next one are stocks. Stocks of FDI measure the total amount of direct investments that exist at a point in time. So this is a snapshot in time. So what is the total FDI investment by this M&E at December 31st, 2020? Whereas the flows would measure how much funds flowed over a period of time. Okay, so here is a chart, and you can see this in your book as well, that shows the a major home country's direct investment stocks. So this is a snapshot in time. So how much is currently invested, and this was at the end of 2011 in billions of dollars. So let's just take a look at the United States. So the United States is the home country. Their total outward FDI, so how much money left the United States to invest in other regions. You can see it's 4,085, or this is trillions of dollars now because we're dealing with billions. So $4.085 trillion, or $4,085 billion. Okay, so huge amount of outward FDI from the US. The NAFTA countries, North American Free Trade Association, that's Canada and Mexico. We've got 422 billion going out. European Union represents the largest amount with 2037. Other industrialized nations, so that's a host of other nations, 418. Latin America, 681. Developing Asia, 373. And other developing, 153. So a lot of FDI comes from the United States. So you can see, compared to any other country, we're a significant amount higher. The US is investing internationally quite a bit. So why do multinational enterprises exist? Well, there's several reasons, and we're going to go through some of them right now. The first reason, actually, let's start off with a disadvantage of doing a multinational enterprise. So the inherent disadvantage of operating a foreign affiliate competing against local firms. So the M&E has to deal with a lot of additional costs and has to be able to compete against the local firms in the foreign country. So this is an inherent disadvantage, but the advantages will often outweigh this disadvantage. First is firm-specific advantages of the M&E, especially intangible assets. So brand name, you know, Microsoft or Google. These are brand names, very well known throughout the world, and so they have an advantage. And sometimes brand names are associated with quality, and so foreign consumers may be very interested in something that's manufactured or produced by a firm, a multinational enterprise based out of the United States. Location factors are also a reason. Location factors based on resource costs and availability, customer demand, government policies, and other considerations. So this is where we look back at some of our former lectures, and we look at comparative advantage of nations, scale economies, governmental barriers to importing into the foreign countries, so tariffs and other things. also trade blocks. So all of these location factors might make it advantageous for an MNE to exist and to try and operate throughout the world. Internalization advantages in using these assets. So sometimes there might be rules about exporting from foreign countries into foreign markets, and it might make it difficult to do direct FDI, foreign direct investments. However, through internalization, these advantages that come, there can be things like a license or an agreement for one firm to use another firm's assets, with restrictions on how the assets can be used, and with payments for the right to use the assets. So licensing happens as an alternative and a way for MNEs to continue to make investment and take advantage of some of the factors or firm-specific advantages that we see out there. There's also oligopolistic rivalry that uses FDI in the firm's strategies for competing. So we're talking about huge multinational firms that can use their decision about FDI as part of their strategy for competing with other huge firms. So how Coca-Cola chooses to use FDI to maybe edge out Pepsi. And so it might be part of a broader strategy for competing against another rival. And so those are each good reasons for having an MNE. Okay, what about taxation? We're dealing now with multiple nations, not just the home nation, but the host nations and their tax regimes. So the profits of MNEs come from the operations of the parent firms and their foreign affiliates. So parent firm is earning revenue in the home country, their foreign affiliates are earning revenue in the host countries. So how does this affect our tax situation? So national governments, as we know, impose taxes on business profits. So there are many tax details, and this is what we're discussing now is broadly the outcome for most countries. So this is the standard case, but you have to look at it from a country to country case. So the host country governments tax the profits of the local affiliates of the MNEs. So, you know, when we set up shop in a foreign country through FDI, the host country will tax the profits of this local affiliate of the MNE. The home country government taxes the parent company's local profits earned on its own activities. So the host country will charge taxes for those locally affiliate profits, and then the home country government will tax the parent company for any local profits earned on its own activities. So a little bit more on taxation. Because tax rates vary across host countries, because global MNEs try to minimize the total taxes that they pay, two important issues arise. And so you'll see this, and I hope you'll look for this in the news as you read news about MNEs. So MNEs can shop around among countries and locate its affiliates in the jurisdictions with governments offering lower tax rates. A great example is Ireland. So a lot of companies such as Apple have set up a foreign direct investment or set up their international headquarters for the European Union in Ireland. That's because Ireland had very advantageous corporate tax rates, and so they attracted a lot of MNEs to set up shop in their country. Second, MNEs can use transfer pricing to report more of their profits in low tax countries even though profits were actually made in high tax countries. So we're gonna look at an example right now. So this is an example. You can find it in your book. And so what we're looking at here is there's a multinational company that is manufacturing something in Germany, in their German affiliate, and then what they manufacture here is then sent to their Singapore affiliate to finalize the product, which it can then be sold internationally. Okay, so the question is, how much should the German affiliate charge the Singapore affiliate, understanding that the German tax rate is different than the Singapore tax rate? So here we're assuming that the German tax rate is 50%. So a large amount, 50%. So if we look at before tax profit of $5, the after-tax profit would be $2.50. So 50% tax was taken out. We could look at the same thing for the Singapore affiliate, but the Singapore affiliate only has 20% tax. So we can see here that the Singapore affiliate is, if it makes $3 profit, it'll be able to keep $2.40. So they pay 60 cents in taxes. So what the multinational enterprise has to decide is it can change the amount of cost that it is charging to the Singapore affiliate. Now, in Germany, it costs $8 to manufacture this. And so if they sold this partially completed product to their Singapore affiliate for $13, that would mean that they would recognize a $5 profit. 13 minus $8 cost. They would recognize $5 before tax profit. They would have to pay $2.50 in tax. Well, what if they charged $10 to the Singapore affiliate? Well, you can see $10 minus the $8 cost means that they would make a $2 profit before tax, paying 50% tax. That leaves them with $1. What if they just charged what it cost them to make? They made zero profit. They have to pay zero tax in Germany, and they're able to recognize the full before tax profit in Singapore, which is at a lower tax rate. So you can see, as we look at this, the global effect for the M&E, scenario one, where they charge $13 in Germany. This is the situation. They pay more tax. There's the middle ground. They pay a little bit less tax, but the best and most advantageous way would be to charge what it costs them to make it in Germany and nothing more, so that the profits can all be reported in Singapore. So the global M&E in this scenario has chosen the best tax situation for what they're trying to accomplish. So they've paid the least amount of tax. So M&Es and international trade. M&Es are heavily involved in international trade. In fact, about 1/3 of the world's international trade in goods occurs as intra-firm trade between units of the M&Es located in different countries. So we're talking about trade within the M&E. So from one division of the M&E to another division, or one unit to another unit, one affiliate to another affiliate. So that's about 1/3 of the world's international trade. That's huge. Another 1/3 of the world's international trade involves an M&E as the seller or exporter or buyer, importer, trading with other firms. So 1/3 of international export are M&Es buying or selling from people that are not affiliated with the firm. So 2/3 of the world's trade is done by M&Es. In many industries, a firm must find reasonable trade-off between centralizing production in one or a few locations and exporting to many other countries to achieve economies of scale, or spreading production to many host countries where the buyers are to reduce transport costs, to avoid actual or threatened barriers to importing into these countries, or to gain local marketing advantage. So there's a trade-off here, and MNEs are trying to strike a balance between the benefits of economies of scale through centralized production versus spreading production so as to reduce transport costs and avoid governmental trade barriers. So there are good reasons to think that FDI and trade could be substitutes or complements. Most studies conclude that FDI, foreign direct investment, on average is somewhat complementary to international trade. So they're complements, not substitutes. Should the home country restrict FDI outflows? So you're the United States and you see all this money, what did we say, $4 trillion of foreign direct investment from the United States at the end of 2011. That's a huge amount of money leaving the country. And so governments may think, well, maybe we should restrict the foreign direct investment outflows and encourage those companies to invest locally, invest in our home country. So we can identify several key effects. The effect on workers and others who provide inputs into production in the home country. So if foreign direct investment is restricted, it would benefit home country workers. The effects on the owners of the MNEs based on this home country. So the owners of the MNE actually may lose if they don't do foreign direct investment to take advantage of opportunities. The effects on the government budget, and especially on government tax revenues. And we'll talk a little bit more about this here in a second. And any external benefits or costs associated with direct investments out of the country. So these are key effects that need to be considered as we look at FDI outflows. So a standard statistic analysis of FDI finds that workers in the host country gain from increased demand for their services, as do other suppliers of inputs to the affiliates of foreign multinationals. So the host country, these are the foreign countries where our foreign affiliates are, the workers gain there, obviously. The host country government gains from taxes collected on the affiliate profits, as long as these exceed the extra costs of any additional government services provided to the affiliates. So there might be infrastructure and other things that the government provides to these affiliates in the host countries that cost the government money, but if done appropriately, the host country will gain much more from the taxes collected. Domestic firms that must compete with the affiliates lose. So in the host country, a firm there that is domestic will lose if they have to compete against the affiliate. Overall, there is a presumption that the host country gains well-being in the standard analysis. And I think you can see that overall, that is the case. The host country must also weigh indirect economic effects with respect to the incoming FDI, including any positive externalities from FDI. So MNEs bring technology, marketing capabilities, and managerial skills to the host country. And we can see this, a lot of the original manufacturing of high technology goods in China were because US companies went in and brought that technology with them. Now, of course, China is competing very well on their own with homegrown technology, but they have benefited as a host country to MNEs. While MNE attempts to keep these intangible assets to itself, some of them do spill over to local firms, and you see that. The technology that the US brought to China is now being used to the advantage of Chinese firms as well. Okay, now let's talk about migration. So the movement of some of our factor inputs are people. People play a role in this setting. So international migration is the movement of people from one country, the sending country, to another country, the receiving country, in which they plan to reside for some noticeable period of time. So they're migrating to another country. International migration has played an enormous role in the past expansion of receiving countries. So here we see gross immigration rates into the US from 1820 to 2012 and Canada from 1852 to 2012. So you can see gross immigration. This is the annual immigrants per 1,000 of population. And you can see we've had several spikes. The black line is the United States, the blue line is Canada. And you can see per 1,000 of population, Canada's had a few spikes, and the US itself has had quite a bit. So you see a lot of immigration into the US and Canada over the years, and it continues today. So what about net immigration rates? Here's an example of net immigration rates into the EU, European Union, and this is broken into two different lines here. You've got the 25 EU countries, so this is the full amount from the beginning of the EU, the 10 EU countries, and then the 28 EU countries as we added 3 additional here. So we can see net immigration into the EU is significant. Having lived in the UK, in England, I saw a significant amount of immigration. We also see in Europe a lot of refugees and others immigrating into European Union countries because people are seeking out a better life, and we see that. So that brings in people as a resource that can be used if utilized properly. So how migration affects the labor markets in the receiving countries. So freer migration makes wage rates in the migrant-related occupations more equal between countries. So the more free the migration, the more equal the wage rates will be amongst countries. And this is for migrant-related occupations. Now in the US, a huge amount of our migrant population do more manufacturing and production type jobs. You know, in my town, a lot of the migrant workers do things such as yard care, construction, other things like that. So the freer the migration, the more equal between countries will be the wage rates. Directly competing workers in the receiving countries have their pay lowered, however. So a domestic worker will have their pay lowered if the country is receiving a bunch of immigrants. Relative to less immigrant threatened occupations and relative to such non-labor incomes as land rents. So those directly competing workers will have a lower pay comparatively. Immigrants' earnings catch up partly within their own lifetimes, and we see that as well. We see a lot of the immigrants in the US over their lifetime, their earnings start to catch up to those domestic workers. So world output is raised by allowing more immigration. So it's a factor input that can aid in world output. Should the sending country restrict immigration? So the country that immigrants are leaving, should the sending country try and restrict that? The standard economic analysis shows that the sending country loses national well-being. So they're losing their workers. Those workers are going to a foreign country. The effects on the sending country government budget, there are 2 effects we're going to look at. The sending country government loses the future tax payments that the immigrants would have made. So if those workers had stayed in the sending country rather than immigrating to the receiving country, then they would have worked, they would have paid taxes, and the sending country government loses those when they immigrate. Also, those who immigrate no longer require government goods, services, and public assistance, so government spending goes down. So while their tax revenues go down, so does the required spending go down. And so those two factors may partially offset each other. The sending country, however, can benefit from remittances sent home by immigrants. So immigrants go to a foreign country, they start to make some decent money. They'll send some of that money back home to family. And so the sending country can benefit in that way. Should the receiving country restrict immigration? This is obviously a big political debate in the United States. Immigration, should the US allow these immigrants to come in to our country? Well, the standard economic analysis shows that the receiving country gains national well-being as a whole. The country as a whole is better off. So the US is better off because of the immigration that occurs into the US as a whole. Effects on the government budget, government tax, and other revenues go up, but so does government spending. External costs and benefits. There are knowledge benefits, congestion costs, and social friction. In interest of time, we won't cover these in detail, but I recommend you reading those from your book. So a net benefit is more likely if the immigrant is a young adult, better educated, and in better health. This would show there would be less government spending and higher revenues, because these are working young adults who can contribute to society and pay taxes and not be a drain on healthcare or other things. And so that's when it is more advantageous for the home country. Okay, with that, we've concluded our discussion on multinationals and migration. And we can see some benefits and some disadvantages throughout, but in general, foreign direct investment and immigration can help to improve and bring benefits to the world as a whole. If you have any questions, please give me a call or shoot me an email. Happy to chat. Thank you very much.